If you've been watching the crypto market lately, you'll know the feeling. Price feels heavy, volatility feels sharper, and everywhere you look, there's a new explanation being thrown at you for why the market is acting the way it is. One of the narratives that's suddenly everywhere right now is the Clarity Act. Some people are calling it the thing that crashed crypto. Others are calling it the beginning of the end for decentralisation. And a few are quietly saying it might be one of the most important moments crypto has ever faced. So in this video, I want to slow this right down. Not to hype it, not to panic you, and definitely not to give you a surface level explainer that you'll forget in 5 minutes. This is about the story behind the Clarity Act, why it exists, why the market is reacting the way it is, and what actually helps something like this get passed in the real world. Because what's happening right now isn't really about the bill, it's about a transition. But before we get into that, if you're new here, welcome. My name's Paula, and on this channel we talk about crypto and markets in a very real, grounded way. We don't promise overnight riches, we don't ignore risk, and we don't pretend price moves exist in a vacuum. We talk about structure, psychology, macro forces, and how it all connects, because that's what actually helps people survive long term in this space. Before we go any further, a quick word from today's sponsor, Blowfin, because the timing makes sense. I know the markets have been tough lately. If you're holding spot, there's a good chance your bags are down, and that can feel heavy, especially when sentiment is already shaky. But at the same time, if you're someone who understands risk and you're trading with a plan, leveraged markets haven't been quiet at all. In fact, this kind of volatility is exactly where real opportunities show up. And that's where Blowfin comes in. Blowfin is a crypto derivatives exchange built specifically for traders who want deep liquidity, fast execution, and clean, reliable infrastructure, especially during high volatility periods like the ones we're in right now. One of the reasons I like Blowfin is that it doesn't try to overcomplicate things. The platform is intuitive, execution is smooth, and importantly, they take security seriously. They use strong risk controls, transparent systems, and they're designed for people who actually want to trade, not just gamble. They also offer competitive fees, solid liquidity across major pairs, and advanced tools that make managing risk easier when the market is moving fast. And Blowfin is offering something specifically for my community here. If you sign up using the link in the description, you'll get access to exclusive trading rewards and bonuses that aren't available elsewhere. And if you're already trading, that kind of edge matters more than people realise over time. Now, obviously, leverage trading isn't for everyone. It carries risk, and you should only ever use it if you understand what you're doing. This isn't financial advice, it's just about having the right tools if this is the route you choose. Alright, let's get back to the video. Because what's happening in the market right now isn't just about volatility. It's about structure, uncertainty, and a bill that's forcing crypto to grow up faster than it's comfortable with. For most of its life, crypto existed in a kind of regulatory limbo, not because governments didn't notice it, and not because regulators didn't care, but because no one could agree on what it was. Was Bitcoin money? Was Ethereum infrastructure? Were tokens shares, commodities, or something entirely new? And in the United States, that disagreement turned into a silent tug of war between two very powerful institutions. On one side, you had the US Securities and Exchange Commission, which increasingly took the view that many crypto assets look like securities, and therefore fell under its jurisdiction. On the other, you had the Commodity Futures Trading Commission, which argued that crypto behaved far more like commodities, especially in spot markets. And because Congress never clearly stepped in to draw lines, something unusual happened. Regulation by clarity was replaced with regulation by enforcement. Projects didn't get told the rules up front. They found out after the fact, usually through lawsuits. Exchanges operated on interpretation and precedent, and investors were left guessing what mattered and what didn't. But here's the important part. Despite all that uncertainty, crypto didn't die. It grew, it attracted talent, it built infrastructure, and eventually it attracted institutions. That's the first tension in this story. Crypto survived chaos. So why does clarity suddenly feel scary? The answer lies in why the Clarity Act exists at all. This bill didn't appear because politicians suddenly woke up one morning and decided they loved crypto. It appeared because crypto outgrew ambiguity. Once spot Bitcoin ETFs entered the picture, something fundamentally changed. Traditional finance stepped fully into the room. Custodians needed legal certainty. Asset managers needed frameworks they could justify to boards. Compliance departments needed definitions that would stand up in court. Big money doesn't move into grey zones forever. At some point, it demands rules, not to kill innovation, but to protect itself. And that's where the Clarity Act really is. It's Washington acknowledging that crypto isn't going away, and that pretending it doesn't exist is no longer an option. At its core, the Clarity Act attempts to answer a question that's been left unresolved for over a decade. When is a crypto asset a security, and when is it a commodity? It tries to create a framework where a project might start its life as a security, when it's centralised, funded and controlled, and then transition into a commodity once it becomes sufficiently decentralised. It aims to give clearer authority over spot crypto markets, reduce the reliance on lawsuits as a regulatory tool, and replace ambiguity with structure. On paper, that sounds reasonable. So why is the market reacting like this is bad news? Because markets don't react to outcomes. They react to transitions, and transitions are where uncertainty lives. The Clarity Act represents a shift, not just legally but culturally, from a Wild West phase of crypto where innovation moved faster than regulation, to a structured phase where compliance starts to matter. From a market driven primarily by retail participation to one increasingly shaped by institutions. From an environment where ambiguity benefited speed to one where clarity benefits scale. Even if that destination is ultimately bullish, the journey is uncomfortable. Traders aren't asking whether clarity is good in 10 years. They're asking what happens next month. What if my token is classified the wrong way? What if exchanges preemptively delist assets to reduce risk? What if liquidity dries up temporarily while everyone waits for guidance? What if I'm early, but early in the wrong place? And here's something that's crucial to understand. Regulation doesn't kill markets. Repricing does. When expectation shifts, prices adjust, often violently. And that's where a lot of the fear you're seeing right now is coming from. But there is another layer to this story, because the Clarity Act isn't just about crypto, it's about power. Specifically, it's about who gets to control one of the fastest growing financial technologies of our time. For years, the SEC had expanded its influence over crypto largely through enforcement, lawsuits, settlements, threats of action. The Clarity Act challenges that approach. It doesn't remove the SEC from the picture entirely, but it limits how far its authority can stretch without congressional backing. And institutions don't like losing power, especially bureaucratic institutions. That's why progress feels slow. This is why language gets contested. This is why headlines suddenly turn hostile. What you're watching isn't a debate about investor protection, it's a turf war. And turf wars don't resolve quickly. So let's talk about the part that actually gives this story direction, the idea of a skinny bill. In US politics, when comprehensive legislation becomes too complex to pass, lawmakers often strip it back to the essentials, not because they've solved everything, but because solving something is better than solving nothing. A skinny version of the Clarity Act would likely focus on one thing above all else: market structure. Clear definitions, clear jurisdictions, clear lines. Who regulates what, when, and why? It would leave more controversial areas, consumer protections, tax treatment, DeFi edge cases, for later debates. And that matters because skinny bills are far more likely to pass. They attract bipartisan support, they reduce political risk, and they give institutions the one thing they value more than optimism: certainty. This kind of clarity doesn't create price explosions overnight, but it creates something more important: a foundation. Foundations don't pump price, they support it. And this is where the story becomes uncomfortable for parts of the crypto community. If crypto wants pension funds, if it wants sovereign capital, if it wants long-term legitimacy, then clarity isn't optional, it's inevitable. What actually helps a bill like this move forward isn't retail outrage on social media. It's pressure from institutions that now have exposure, ETF issuers that need certainty, custodians that won't operate in legal fog forever, courts that are increasingly sceptical of vague enforcement. Ironically, periods of market stress can accelerate this process. Volatility highlights the cost of ambiguity, and policymakers respond when instability becomes visible. So, is the Clarity Act what's crashing crypto? No. What you're seeing is a market reacting to a shift in structure, leverage unwinding, and narratives forming after the fact. This isn't a death blow. It's not the end of decentralisation, and it's not proof that crypto failed. It's proof that crypto grew up, and growing up is messy. I want to pause for a second on something that I think is really important. Trading crypto as a retail investor is hard. It can feel lonely. It can feel like there are invisible barriers to the kind of wealth people talk about online. And that's exactly why we created the Crypto Wolf Pack. It's a community where normal people can connect, talk through market structure, read charts together, discuss macro events, and stop feeling like they're navigating all of this alone. And if you want to know the exact strategies we use in the Crypto Wolf Pack to make money in both the bull market and the bear market, we've made a completely free course for you. The link is in the description below. We also break down topics like this even further on the UK Crypto Podcast. We go deeper into psychology and the mechanics behind moves like this, not just the headlines. So join me and Milkshake Matty for weekly episodes on the UK Crypto Podcast. It's right here on YouTube, or you can access it through Spotify. Coming back to the Clarity Act, the most important thing to understand is this. Markets hate the messy middle. They hate not knowing who wins. They hate waiting. They hate transitions. But history shows that markets eventually reward certainty. And whatever form the Clarity Act ultimately takes, full version, amended version, or skinny bill, the direction of travel is clear. Crypto is maturing. That does not mean the end of innovation. It means a different kind of growth. So if you're feeling uneasy right now, that is understandable. But don't confuse discomfort with doom. This moment isn't about today's candle. It's about what crypto becomes next. And if you stayed with me all the way through this video, thank you. If you found it helpful, make sure you like and subscribe. It really helps the channel reach people who are trying to understand this space, not just react to it. And let me know in the comments what you think. Is clarity something crypto needs, or something it fears? Thank you so much for watching. I'll see you in the next one.